Hello and welcome to a fresh new edition of Bazaar Morning Call. I'm Prashant, with me my colleagues Nigel and Rima. Good morning, guys.
Hi.
New highs in the bag, and we are looking ahead with some optimism, some caution as well. US equities are down, and they're down sharply actually, 1.5% in the S&P, the Nasdaq down a little bit more. You have the dollar, which is, risen once again. It's bounced off important levels. It's technically looking like it's going higher, and SGX is indicating a lower start. The last I checked, by about 50, 60 odd points, just under 18,700. I mean, starts are one thing, closings are another, like yesterday showed us. So will we see a repeat, a lower start, which, slowly but steadily gets bought through the course of the day? That's the question we'll try and answer. The global picture is not very comforting, and that's, I think, also needs to be highlighted. We'll do that. That's the dollar index, which actually bounced off. It's not going one way south. There is some support which is coming in. Good morning, guys.
Hi, good morning. So yesterday, there were two reasons attributed to that 1.5% sell-off in the U.S. markets. One, the COVID protests in China, and two, the hawkish comments from a lot of the Federal Reserve's William as well as Bullard. Both of them seem to indicate that we are going to get higher rates for longer, for an elevated period of time. But just take a look at the Asian markets this morning, right? So while the COVID protests brought down the house down in the U.S. markets this morning, Hang Seng is up nearly about 3%. The Chinese markets are up close to about 1%. And even the Taiwanese markets and the Korean markets, which have great linkages with the economy in China, are currently up in the green. That said, the SGX Nifty is still down close to about 60 odd points. But let's see whether we can attempt a bit of a rebound after opening slightly subdued. But a quick word on the kind of flows that we had yesterday. Both the FIs and the DIIs were buyers in the cash market. The net institutional buy figure was in excess of close to about 1,000 crore rupees. Perhaps there is a lot to do with the MSCI rebalance. Nimesh indicated in the dealing room yesterday, when we chatted with him, that, the MSCI rebalance would have resulted in inflows into our markets. They come into effect from 30th of November, so perhaps that influenced the kind of flows that we had. And just one more word, take a look at Reliance. Reliance single-handedly pulled up our markets, or supported our markets yesterday, and that's the turnover on Reliance. Nearly 4,000 crore, and off that, close to about 2,000 crore was marked for delivery just on NSE. So I'm not even taking into account BSE, but that was Reliance for you.
4-month high volumes yesterday on Reliance, and had it not been for Reliance, the market would have been down. I mean, actually big time down, because it was the only thing which was holding up things. I'll get to Reliance in a bit, but just a quick word. So you have the S&P and the Nasdaq both down 1.5% each. The dollar index has completed what is basically known as a bullish outside day. It's closed above the Friday's close. So that is a bullish signal, and it's usually followed by more gains. So we'll see, which is not good news. I mean, if it kind of follows through. The only good thing about the dollar index is that the bulk of the move has come through because the euro has fallen. Euro is about 60% weightage in the dollar index, and it's euro's fall which has pushed the dollar higher. So I think that is it's not as if money is going into US assets in any big way. It's just that the euro saw some weakness after the rally recently, so it's pushed up the USD. S&P E-mini futures have completed a bearish outside day, and this is the most widely traded contract, and in the world, and that is going the other way. Now again, volumes were not all that great. Volumes have been better earlier, and as we go into the close of the year, volumes will be lackluster. So take it with a pinch of salt, but this is what we've seen. We've seen a negative signal. On the E-mini futures, the 100-day stands at 3924, and that's the level. About 40 points or so is what you want to see if that level holds. So far, it has. China's COVID-19 situation remains top of mind for global investors. Absolutely. I mean, you had headlines yesterday, for example, from companies like Apple, etc., which saying that maybe Apple is not going to be able to meet their latest iPhone 14 production targets, quotas, etc. By the way, Rima did mention that Hang Seng is up 4%. There are some measures for the property sector which China has announced, and maybe that is essentially what is resulting in this move in Hang Seng and Asian markets. Nifty yesterday made a high, led by Reliance, and then also cooled off. I mean, we were nowhere close to the day's high on the index. Even on Nifty, volumes were not all that great. Volumes actually, we saw a breakout above the trend line, but not quite so as far as volumes are concerned. As I said, Reliance volumes were huge, of course, and without Reliance, the market would not have broken out into new highs. So the new level to watch, of course, is 18,614. And above that, I mean, the level to watch is 18,639. I mean, that's the level to take out really if there is momentum which comes back in. That's the weekly upper Bollinger Band level, which you want to take out, 18,640 broadly. And supports come in at about 18,420. This is the broad breakout zone from where the Nifty started moving higher. So, I mean, if you're so inclined to try and see if, dip buying comes back, I mean, you'd be better advised to kind of find prices around that 18,420 or maybe around that to see if it works once again. But be mindful of the global picture as well, which, I mean, US, for example, US indices were not doing very much, but yesterday they were decisively down by about 1.5%. So maybe wait it out the first couple of hours before you read the texture of the market and decide what you want to do. Najib, what are you watching?
Well, the market continues to be in buy and dips mode, right? But I think in the near term, maybe some bit of consolidation, a bit of a pause on the Nifty. That's something that maybe we could look forward to. And the global picture, well, there are two fears that crept up overnight: supply chain issues, and the other factor is the Fed's hawkish tone. Yesterday's recap, well, the Nifty, everyone's celebrating. We hit a half a century yesterday, but stripped of Reliance, actually, we would be down closer around 20 points or so. You need to take that into account. The broader market participation, for me, that's heartening. The second day running, you had the broader markets that outperformed because the mid-cap and the small-cap indices, they did better than what the Nifty did. Will they continue? Will they continue to fire? Remember, they were underperforming in the previous week. So the broad breadth of the market, if it can improve, well, or it can relatively outperform the Nifty, that'll make portfolios feel a lot better. Now, in the cash market, the institutions, the net bought more than 1,000 crores odd. In the F&O market, well, the Qs are bullish. They added longs, they wrote, puts big time. So that combination is normally rather bullish. And they added close to 15,000 long contracts yesterday, and they wrote close to 80,000 puts. That's in the ratio of 3 puts for 1 call. You like that. Where was the writing seen? 18,500 put, 18,600 put. The total open interest built up between both of them is around 65 lakh shares. The premium out there was around 50 to around 90 rupees odd. So that's giving you a sense that at lower levels, we could see some bit of a support. However, on the upper end as well, the 18,650 call and the 18,700 call. At both these two strikes, there were 14 lakh shares added each. So close to 28 lakh shares were added at both these two strikes. So that brings us to the levels then that we're looking at. You plug in these numbers, looking at the options data, and you get a support at around 18,400 to around 18,450 odd. However, I see resistance at around 18,650 to around 18,700. Yesterday's high was around 18,620, so that becomes a bit of a resistance zone as well. The Nifty Bank, well, the 43,000 put and call was very, very active. I'm just taking the premium together, it's around 400 rupees. So if someone was, writing that, looking at that, writing the 43,000 put as well as the 43,000 call, then you have that 800-point band. So that's the crucial level. A break beyond each of these sides, either 42,600 or on the upper band, 43,400 will be crucial. For starters, SGX 50 suggests a dip. At some point of time during the day, it will become a buying opportunity, and buy on dips has worked. So don't change that. Maybe around 18,450 odd, that will be a good entry level. Prima, what else?
Well, you know what they say about buy on dips, right? All past recessions or turbulence looks like opportunities, and all impending ones look like threats, right? And Indian markets have really climbed all the walls of worry in the last 1 year to get to the levels that it has. So perhaps, if anything, all the turbulence, if you treat it as truly a buy on dips, in hindsight, you realize that it's just an opportunity.
And
but
full marks, Rima, to the retail investor out there. They have shown the faith out there, patiently, and they're riding well now.
Absolutely. The SIPs have been at record high levels month after month. It's only been picking up. So this all-time high perhaps belonged to India's retail investors and the financialization of saving. But a quick word on crude prices. Now, crude prices made big swings yesterday. It swung in a 5 percentage point range. So first, it dropped to levels of $80.6 per barrel on Brent crude. This was on concerns that China's demand is weakening, etc. And then it rebounded all the way to that $83.50 per barrel that we are currently on rumors that OPEC Plus is considering a production cut, which will boost prices. The OPEC Plus will be meeting on 4th of December. That's next Sunday. So watch out for this meeting very, very closely. So keep your eye on crude. It's rebounded a fair bit from the lows that it had yesterday. But let's get to the calls from the wise men about what next.
Oh, absolutely. Across asset classes, Rima. So Chetan Sheth of Nomura remains of the view that while China's path to reopening and moderation of US inflation provide reasons to be more optimistic on stocks looking towards 2023, but it still does not appear to them if it is time to turn outright bullish given uncertainty on the path of China's COVID outbreak and the Fed's policy path.
Some money market views now. Bhaskar Panda of HDFC Bank says overnight the dollar index looked up a bit post the hawkish commentary from some of the US central bankers. He says everyone will be watchful of comments from Fed Chair Jerome Powell on Wednesday. Meanwhile, he adds oil remains subdued and Asia ex-Japan sentiment soured due to the China events. He says Indian currency markets will take cues from global backdrop, and he expects the USD INR pair to trade in a range of 81.5 to 81.7 against the dollar for the day.
On bonds, Bhaskar Panda says that bond yields in India have been trading in a lower range following lower oil prices and lower yields in the US as well. He expects the 10-year benchmark bond yield to trade in the range of between 7.25 to 7.3% for the day.
Well, we have a lot of stock-specific action to track for you, and we'll get to that in just a bit. In our special Top 10 segment, we're looking at Fusion Microfinance, Lupin, NBCC, Lumax, BSE, Ami Organics, NDTV, Apollo Tyres, and JK Tyre. They are stocks on the back of positive news flow. On the flip side, you have Five Star Finance. That's the stock that's likely to open up in the red.
Okay, Rana Gupta is now joining us. He's Senior Portfolio Manager, India Equity Specialist at Manulife Investment. Rana, great to have you back on the program. Thank you very much for your time. The US sold off a little bit last night. Is the rally maturing in the US, or you think there is more to go? What's your sense?
Good morning. Well, I think US markets, they have to deal with their own dynamics of earnings. And the view is that the earnings will face some downgrades in the coming year. So I think the multiple has broadly, by and large, adjusted to the new interest rates. We have to see how much of earning downgrades can happen. Our sense is that this earning downgrades, markets expecting somewhere around 10-15% thereabouts. The earning downgrades could be a bit lower than that, given the nominal growths are quite high. But overall, I think it's going to remain range-bound with volatile like it has been for last few months.
Rana, morning. Everyone's watching the China COVID protests, and what direction will it take from here? Is there a chance that this could escalate into much bigger, which will challenge the current authority, or do you think it will be quietly suppressed and therefore things will be back to usual as it was, say, a week ago?
Look, I think China and their COVID and the response to something we have been discussing throughout this year. And frankly, none of us are any wiser on that. So I think we would rather focus on the long-term fallouts on the emerging markets because of the situation. And one of the fallouts which we can see with some degree of certainty is the restructuring of the supply chains, which means that the global multinational companies incrementally they're putting capacities outside China in countries like across emerging markets, whether it's Mexico, Vietnam, India, Indonesia. And we will be pretty optimistic on that trend. And coming to India, I think thanks to the reforms that has happened in manufacturing, in tax reforms and other things, India can be a good recipient of that friendshoring or restructuring of supply chains.
Hi, Rana. Good morning. I recall when we chatted last, you were a little bit cautious on two factors. One was we're celebrating that interest rates will get pulled back maybe too quickly in comparison to what it could likely be the case. So what are you factoring in? Overnight you have some commentary that says maybe in 2023 as well, there'll be no interest rate cuts. What are you factoring in from here on in terms of hikes? And also on the Indian markets, you said that there will be revenue growth, but the profitability may not grow that much. So for the Indian markets, what kind of earnings growth are you factoring in?
Sure. The first part of the question on the interest rates, I think the market's expectation of US interest rates has gone up to something like, let's say, around 5%. And that's why I said that the market expectations are pretty much aligned with what we think and what Fed thinks. And the rates have gone up very fast. But that high rate is now done. Now the question is that how longer this high rate will sustain. Our view is that somewhere in the H2 of next 2023, you will see some rate cuts as US growth tends to slow down. So I think that's the view on the rate side. Okay. It's clearly peaked, but I think the cut is some time away. Regarding Indian markets, yes, the revenue growth is going to be quite strong as we have seen, and that's a function of high nominal growth and the banking and the industrial growth that you are seeing. On the margin side, I think we will get a very mixed picture. So margin side will get a very mixed picture. What will happen is that for companies who has a lot of spare capacity, they will have some volume leverage to offset the margin pressures. And in this kind of environment, we have to look for companies which has very good cost control and which can offset their margin pressure. So I think one of the key strategy I would like to highlight is this. Over last 10 years or so, it was all about buying quality companies with pricing power. Now, I think next few years is going to be about buying companies with very good cost control or having a lock on the cost due to historical holding of assets or something like that. Because the revenue line is going to do well because of inflation anyway. Companies having cost control can outperform because their margins will not as much under pressure as the rest of the market. So I think it's a both opportunity, and for some companies it's a threat also. But I think there are enough opportunities out there as well.
Rana, very briefly, if you can tell us in your portfolio, what are you most overweight on and what are you very underweight on? And at the margin, what would you look to do in terms of making changes?
Right. So we can share about our views on the sectors. The two most sectors where we are most positive are industrials and banking. Industrials is going to, due to the fact we shared earlier, that we are bullish on the restructuring of supply chains and also the domestic capex scenario in India. So industrials, particularly in the areas of auto ancillary, in chemicals, in capital goods area, we are quite positive. We like the large cap banks also, because I think the credit growth is quite strong, cost picture is quite good, credit cost is not a concern at all. So I think the large banks will continue to deliver very good numbers. So banks and industrials, also real estate, because I think the real estate sector is picking up after a long time. So these are sectors that we like. At the margin, we would be a bit more cautious on, let's say, something like when I say consumer, it's not all consumer companies, but there are many consumer companies who have the very volatile input prices. So I think the margin scenario there, we would be a little careful. It's not like a blanket bullish or a bearish thing, but I think any company which has margin pressures, i.e. the inputs come from, let's say, energy linked or metal linked, we have to be a bit careful over there.
Rana, we'll leave it at that. Thank you very much for joining in. That's Manulife, bullish on India's industrials, large banking stocks, as well as real estate. A bit cautious on consumers, where the margins have been, or historically have tended to be a bit volatile. Get into a break. Up next, our list of top 10 stocks is lined up. Welcome back. You're tuned in to Bazaar Morning Call. This is the time where we tell you all the stocks that should be on your radar this Tuesday morning. Our entire research team is standing by with CNBC-TV18's top 10 list of stocks for the day. And first up, let me invite Surbhi. She's going to tell us about 5-star business finance and Fusion Microfinance, why you should be watching these two. Surbhi?
Thanks for that. Let's start with 5-star finance. The company manages growth and margin improvement on lower interest costs, but OPEX and higher provisioning, that keeps the profit in check. The loan book is up nearly 8% on a sequential basis. The net interest income is up 10% at 301 crores. The OPEX is up 12.5% at 100 crores. The losses and provisions that have come in at 8.5 crores versus negative 4 crores in the previous quarter, and the PAT is up nearly 3%. So we'll go with a red on this one. Next is Fusion Microfinance. Now Fusion manages good growth, and that helps contain some concerns on the rising NPA and the expected credit losses. The AUM is up 9% sequentially at 8,000 odd crores. The NII is up 31%. The PAT is up 27%. The net interest margins that have come in at 10.2% versus 9.4% in the previous quarter. The gross NPA has come in at 3.83%, and the expected credit losses have come in at 285 crores versus 244 crores in the previous quarter.
All right, thanks a lot for that, Surbhi. Well, let's hop across to Ekta. She's standing by to tell us some more stocks and the news. Morning, Ekta.
Hi, thanks for that. Well, yes, I'll start with Lupin, which is in focus because their subsidiary in Brazil has signed an agreement to acquire 9 medicines from an arm of Bosch Health Companies. We don't know what they're spending on it, but just to put it into perspective, Lupin's market share is around 4% in Brazil as of FY22. It's a part of their growth markets, which is 11% of their total sales. And the entire section of growth markets was up around 27% in Q2. So that particular section of markets is doing well for Lupin. Lumax and separately, Antique has also upgraded the stock to buy from hold. So maybe that would add in terms of momentum. Lumax, there's a board meet on the 7th of December to consider and approve a proposal for setting up the company's new manufacturing unit in Pune. So that stock would be in focus. NBCC has won 2 orders worth around 271.6 crores. I expect all of these stocks to see some green today.
All right, Ekta, thanks very much for that. More stocks with news flow. Vivek is standing by with that list. Vivek, hi, morning.
Well, good morning. First on my radar is the NDTV. The transition process of the company to the Adani Group has become smoother. Now, NDTV promoter has agreed to issue almost 99.5% of its total equity to an Adani Group subsidiary. So, expect some positive on that stock as well. Now, AME Organics, yesterday the stock was buzzing. There was, the company had declared to the exchanges that it had received a multi-million-dollar multi-year deal. And along with that, some fund action as well in yesterday's trading session. Norges Bank bought almost 10.9 lakh shares, and they also saw ValueQuest Investment Advisors pick up another 1.8 lakh shares in that particular counter. Also keep an eye out for BSE. The wait as far as the appointment of an MD and CEO has come to an end. The SEBI has gone ahead and approved Sundararaman Ramamurthy as the new MD and CEO of BSE. Remember, this particular position has been vacant since July 2020. And according to his LinkedIn profile, currently works at the Chief Operating Officer of the Indian arm of Bank of America and has earlier been associated with NSE. So some development, some clarity as far as BSE head is concerned as well.
Okay, thank you very much for that. Yesterday, all the tyre stocks were higher. JK Tyres, CEAT, Apollo Tyres. Is it on account of the fact that rubber prices have seen a sharp fall? Manisha is joining us and she's going to give us the latest on rubber prices and the trend. Manisha?
Thank you so much for that. Well, absolutely. The rubber prices have been on a declining trend, and we are trading at a 2-year lows for a second straight day in the global markets here. There have been concerns on global recession, supply chain issues, China COVID restrictions, and then you have more news now coming in as Toyota also downgrades Japan production forecast for the year FY23 there. And this is not the first company or the first country we are hearing that. We have seen these kind of downgrades come in Europe and China earlier as well. Also, when you look at the global annual production of rubber, that in this year is expected to go up by 4%, while the annual demand is expected to gain up by 1.9%. So everywhere that you look, the numbers are slightly on the weaker side, even as we've seen the demand increase, even as the production and demand for replacement and new tires has been increasing, the overall trend still is slow.
Manisha, thanks a lot for that. Well, here's a quick recap of all the stocks we just covered for you. Stocks with positive news flow include Fusion Microfinance, Lupin, NBCC, Lupin, you have BSE, AME Organics, NDTV, Apollo Tyres, and JK Tyres. Well, just one lone stock with negative news flow. That's 5-Star Finance.
All right, that's a list to watch out for. Here's some more opinion from Allianz's Mohammad Al-Arian on the impact of COVID protests in China on global markets and supply chains all over the world. Listen.
I think the impact on the commodities market makes sense because it's pointing out to slower economic growth, and the commodity markets won't be impacted by the supply disruptions. On equities, I'm surprised it's not more differentiated when it comes to U.S. equities. I think the main story in the U.S. is the Fed, so Wednesday will matter, is the labor market, so Friday will matter. China, unless it gets to a geopolitical issue, I don't think it should matter as much as people seem to think it should matter for the US market. So Europe, completely different. Asia, completely different. You cannot rewire supply chains overnight. Karl Bass was absolutely right. It takes a long time to rewire these supply chains. So what does it mean for those companies? It means supply uncertainty. What does it mean for us as a whole? It means a possibility that between what's happening in China, between the change in globalization as a whole, between reshoring, nearshoring, we may have an issue where inflation gets stuck at around 4%. I don't think it impacts the Fed in any way.
Okay, the protests may impact the supply chain and demand, but it doesn't impact the Fed's decision, the volatility that we're seeing in the Chinese markets. That's the opinion coming in from Mohammad El Arian. Get into a break. On the other side, Sanjeev Bhasin, director at IFL Securities, will join in for some stock talk. And also, Kumar Subbiah, Chief Financial Officer at CEAT, will join in to talk about the decline that we've seen in rubber prices and the impact it will have on the company's margins. Stay tuned.
All right. I mean, it looks like Asia is setting the tone, isn't it? I mean, Asian markets yesterday were down. US was down this morning. Asia is not following what the US did, which was down sharply. It's higher. Hang Seng especially is up 4%. But as I said, with regards to Hang Seng, there are specific property sector measures which have been announced yesterday late night in China, and that is boosting. I mean, that is the single most important sector in China, property. In terms of contribution to GDP, contribution to jobs and everything. And that's been the reason why, I mean, China bears have been so bearish that they don't see the property sector coming back up. So this is the latest in a series of measures to boost that sector. And we'll go into more details later on. Okay, we'll hear out some important opinion that we got yesterday. This is from people like Mark Mobius, needs no introduction, a veteran emerging market investor. Shankar Sharma also is someone who we spoke with, remains very bullish from a 4-5 year perspective. Listen in.
As soon as we get more money and we put more into India, plus we diversify. Turkey, we're putting money into Turkey, we put money into Brazil and others. But at the end of the day, India is going to be the bright spot from a long-term perspective. But of course, one constraint for India is government regulation. As you know, for foreigners to come into India, there's some bureaucratic steps that have to take place. And the degree to which Mr. Modi is going to eliminate these barriers will be a big plus for the market. And I know he's working on that. He's programmed to speed up the improvement or the agreement process is very, very important.
India is a standout market, I think, not just, in the last 1 year or 6 months. I think it's going to be a standout market for the next several years, could be 2, 3, 5, 10 years. I mean, I don't think any other market will compare, ticking all the boxes. I'm absolutely clear. There will be obviously ups and downs, that's part and parcel of the game, but at every point out into the future, India will be standing out as a clear outperformer. And, but then the way I invest is that, not always one, all eggs in one basket. And, Turkey, I bought about 2 months back the ETF, which was 33.24. It's up 40% as a market, in dollar terms in 2 months' time. So that is working out well. I think India and Turkey, if you ask me, both very similar countries, both great industrial powerhouses which have been shadowed by China. They are now, coming into their own. And India, of course, is way ahead on all macroeconomic parameters.
Okay, let's move on and invite the management of CEAT on our show. Remember, tire stocks were higher in trade. Even CEAT rallied close to about 7%. We didn't chat with the management post their Q2 numbers, but the numbers were fairly good. Margins improved on a sequential basis to close to about 7%. And this morning, we've woken up to a very sharp decline in rubber prices. Rubber prices are now close to a 2-week low. Kumar Subbiah, the CFO of CEAT, is now with us on the show. Morning, this is Rima here. In the conference call, you had indicated that you expect the raw material basket for Q3 to decline by 2.5% to 3%. Is this, commodity disinflation playing out as per your expectation? Because rubber prices have taken a tumble. And if you could tell us what are the average natural rubber prices today versus the average in Q2 and the margin expectation for Q3 now?
Okay, we stand by our earlier projection of raw material prices going down by 2.5% to 3% in Q3 versus Q2. Okay, so therefore, I don't think there is any big change vis-a-vis our earlier assumptions. As far as rubber prices go, in the international as well as local prices, there has been gradual decline in the prices since September. Okay, and I would like to also point out that international prices will have to factor in the rupee depreciation. Okay, rupee has moved up from 75 to $1, now closer to about 82 per dollar. So, and therefore that also has some impact on the arrival prices, while the base level prices have come down. So overall, the local prices are in the range of about 148 to 150 rupees per kg ex Kerala, and international prices on CEAT basis in the range of about $1,350 or so. So there has been a correction of about 10-15 rupees per kg in the last 2 months, both international as well as local. That is the kind of movement that we have seen.
All right. Hi, Mr. Subbiah. Good morning. I remember the last time we chatted, the hint was that by Q4, hopefully you see double-digit margins. Do you stick to that, going by what's happened, since the last time we chatted? And what about Q3? Should we see some further margin expansion going by what you're saying? Rubber prices are a little bit lower, and you'll also, have a benefit of some price increases. Go ahead, sir.
Okay, no, we took price increase in Q2, largely in the two-wheelers segment, which was long overdue. Sometime in the month of August, we took some price increase, and some marginal increases in the month of October and some of the other categories. Okay, as far as the current quarter is concerned, as the raw material prices are likely to go down to the extent of 2.5% to 3%, to that extent, there will be some favorable impact on margins. As far as Q4 is concerned, I think should the raw material trend continue downward as we are seeing in the recent past, and assuming that our prices remain the same, we expect Q4 margins to be a little better than Q3.
Will it be in double digits, sir? Because double digits we haven't seen all the way since March 2021, and the street is banking on some improvement. So double-digit margins in Q4, that was the hint last time as well.
No, last time you asked a question whether it is possible. Yeah, I said it is possible. Yeah. But I think we would like to provide some indication closer to beginning of Q4. Okay, a little early, because margin is also a function of not only on raw materials but also on the top line category mix and things like that. Things look positive. We hope Q4 margins to be better than Q3, but we would like to wait and then only confirm maybe closer to the beginning of Q4.
Mr. Subbiah, is it better we maybe talk about gross margins, and will that do you have more confidence that there things maybe may continue to trend higher?
Yeah, it is. I think because the way rubber industry looks at gross margin is selling price minus raw material cost. Okay, so considering drop in raw material cost, we expect gross margins to improve. And you would recall our gross margin has moved down from closer to about 40% 1.5 years back to about 31% level. So therefore, there is some need for us to take the gross margins up. So we expect gross margins to move up in Q3 as well as in Q4.
Now that stands at 32.4% at the end of Q2. Could you give us a roadmap in terms of how this could go on? I mean, at the end of the day, this depends on commodity prices, so it's tough to call. But what's your best sense?
No, currently the other way of looking at gross margin is that what is the raw material cost as a percentage of turnover? Considering raw material cost correction is expected in the range of about 2.5% to 3%. So that much expansion we expected to happen in Q3. I think Q4 we would like to wait a little more because we can't come to a conclusion based on one day's price. Many of our raw material prices are based on what happens in the previous quarter, okay, and overall our covers and things like that. We expect the gross margin to go up in Q4, but we will be able to provide more clarity maybe closer to beginning of quarter 4.
But to the extent of
is likely to go up.
To the extent of 2.5 to 3, so that's 300 odd basis point improvement in gross margin over Q3 and Q4.
No, over Q3 or Q2, okay, and raw material being around 65 to 70% of our turnover. So if raw material cost comes down by about 2.5 to 3%, that 65% should be applied on that 2.5-3% in terms of gross margin improvement in quarter 3. Quarter 4, we would like to little wait and then only provide you some kind of a sense.
Okay, so definitively Q3 margin should be better than Q2. Q4 margins, you're hopeful will be better than Q3, but you will assess, closer to the start of the quarter. What are the volumes that you're currently tracking, sir? So far in Q3, in Q2, your overall volumes were about 7%. Of that, exports and replacement were flat, while OEMs were roughly about 20%. So vis-a-vis that, if you could tell us, in the first 2 months of this quarter, what are the volumes looking like?
Okay, Rima, you are aware that in generally a quarter 3 revenue tends to be a little lower than the rest of the quarters. So therefore, we would certainly be seeing double-digit kind of a growth versus the same quarter of last year. Okay, however, quarter 3 volumes could be in line with quarter 2 or could be marginally lower than quarter 2. So quarter on quarter, you would see that kind of a trend. As we saw in quarter 1 and quarter 2, okay, OEM continues to grow faster than the other 2 categories. I think the same trend we are seeing in the first 2 months of the current quarter 2.
So should we say 5 to 7% kind of volume growth in Q3 as per what things stand right now?
No, over the same quarter of last year, yes,
okay.
But not quarter on quarter.
Yes, okay, year on year.
All right. Mr. Subbiah, so business is shaping up well. The other triggers, you have raw material costs that are cooling off. You have the unlock that's working out, and you have a large proportion of exposure to the replacement market. The other point is, has debt levels peaked out? Are they close to peaking out? So by the end of this year, what will the debt number look like? And your capex plan of around 750 crores, you're sticking by that, right?
Yeah, absolutely. In quarter 2, our debt level moved up by about 200 crores.
Yes.
Okay. And, we are sticking to our initial forecast of 900 crores of capex, which includes 750 crores of project capex. So therefore, for the full year projection, we would like it to be in line with our earlier estimate. And just to tell you, in the first 6 months of the current year, we spent half of the 900 crores, about 450 crores. And from here on till end of the year, okay, we expect our debt level to move up in the range of about 300 crores approximately. It is based on our current overall cash flow estimates. Okay, it could change a little bit depending on how we manage our working capital.
You're saying 300 crore, the debt will increase over Q3 and Q4. So you could end up with a debt number of closer to 2,600.
Yeah, yes.
And after that, sir, in FY24, does debt further increase, or will it then be on a downward trend? Because you...
Yeah. Sorry, go ahead.
No, go ahead. Just wanted to understand, what is the net debt to EBITDA that you're comfortable with as a level as well if it continues to rise?
Okay, no, see, net debt EBITDA, we are generally keeping around 3. Under 3 is what we are normally working towards. In the event we see any risks in terms of debt level going beyond 3 is when we try to exercise some control on capex. So as far as the current year is concerned, we would like to be in line with that. Okay, and in the event we see some risk, okay, quarter 4 we may exercise some control on capex. As far as next year is concerned, okay, you are aware that in the last board meeting, board approved a capex of about 395 crores in expanding our specialty tires, OHT tires at our Ambernath plant. Some part of that capex would be spent. We have not yet frozen our capex for next year. However, we would expect that to be lower than the current year. Maybe in quarter 4, we would be able to provide some guidance once our annual plan is completed.
All right, fair enough. Thank you very much, Mrs. Subbiah. Appreciate you joining in. Always a pleasure. So in the second half, margins definitely will improve, although on a quarter-on-quarter basis, volumes Q3 over Q2 will be flat to slightly lower. Sanjeev Bhasin is director at IIFL Securities. We are shifting gaze from corporates to markets. Sanjeev, you promised to be in the studios when markets hit a new high to do that Bhangra. So I guess we'll have to do this long distance.
Yeah, good morning, Prashant.
Good morning.
Set up the flow and I'll be there. Get the Dhol Gala. Get Nigel to join in and we'll do it.
No, I'm ready. Sanjeev, I'm ready. I'm doing it.
Sonia is missing in action, but Rima is here.
Rima's filling in. She's joining in. Rima, Bangla. Yeah.
Sanjeev, how are things looking now? I mean, you've said buy despair, sell euphoria. That's basically been your mantra, right? How are things looking now that we've crossed that new high, in a way uncharted waters? Will the push higher keep continuing? What's your sense?
Yeah, firstly, that was a very poor imitation of a Bhangra. So, I'll have to come and guide you guys, because sooner rather than later you will have to join in.
That was Nigel and Rima. You're not seeing me in action.
All right, let's go. Prashant, go for it.
All eyes on you.
All eyes on Prashant. Come on, Prashant.
Don't get me started.
Come on, Prashant,
don't get me started. Nigel. Go on. Sanjeev, go on.
So Prashant, like you said, buy the fear, sell the greed. And now the greed is evident. The dumb players are the FIs who sold aggressively till 15.5, not realizing that the best market or the best player in town and the outlier is India. And now you are seeing the, let out feeling of missed out use. So, there's a simple saying, you can't run with the hares and hunt with the hounds. This is the time you must start to book profit. If you've had the very, very good spell, which we've given you in the last 4 months, and if you are laughing your way to the bank, it's good time to take some money off the table, particularly some of the PSUs. And I think that wait for corrections which are imminent, which may come in January. But I still think there is a bit of upside on a stock-specific basis. Index may hit 18,800, 89,000. See, the euphoria is just starting, and you've seen the type of missed out feeling. Plus, now there's a global, festive season with most people realizing that historically December end has always been a good month. And I think that we'll take it from there. But definitely take some money home, because this is not the time to keep being adventurous. If you have bought the fear and this is the euphoria, you need to be, in the money now.
Well, Sanjeev, good morning. I'll work on the Bhangra skills. I'll take some, I have the Punjabi at home, so we'll try to work on that. But what do you buy from here, Sanjeev? There's still a lot of opportunities, right? Take some money home, as you said, on some of those PSUs and look to get in at a dip. But any key stock that you're looking at? I mean, a couple of names if you could give us.
Yeah, so firstly, I am waiting for you and your wife to join me in Punjab da Tadka with butter chicken.
Absolutely.
And we'll do the Bhangra with roaring, because she's more adept at it. so Nigel, look at the auto names. You just saw what Apollo Tyre, what CEAT are guiding. Look at the CV volumes, look at the bus volumes, look at the airline traffic. I think Ashok Leyland and Tata Motor fit that bill perfectly. Tata Motor is still seeing a little bit of if and how because of China, but once that stabilizes, Europe numbers are very strong on a monthly basis, on a yearly basis, and I think auto demand is very strong. So Ashok Leyland, Tata Motor would be my 2 top picks. Canfin Homes is one mid-cap which I've been advocating for some time, from that 470, 480 level. That is headed to 700, 725. Because in the mortgage space, that's one of the 3rd largest player and one of the largest player in the 15 to 30 lakh ticket. I like Ultratech and L&T in the large caps. In the OEMs, Motherson is giving you the opportunity of maybe the last 2 years, because as soon as Europe starts to stabilize, the volume and the growth on margins will come back with a vengeance. Bosch fits the bill perfectly as far as the largest OEM goes. And you have the real estate play with DLF, Godrej Property, and on the consumption side, Godrej Consumer. So a lot of names, but I would concentrate on the CV players and Ultratech and Canfin Home.
Sanjeev, there is an interesting note by CLSA on Paytm where they've upgraded the stock to a buy, and here are a couple of the reasons. One, they're saying that the share price has seen a sharp correction, just 25 to 30% in the last 2 weeks on account of selling by a large shareholder. They're saying the market cap is at $3.5 billion. Of that, $1 billion is the cash that the company holds, and they're saying the cash burn is likely to end in the next 4 to 6 quarters. And this market cap of $3.5 billion was the valuation last seen in Paytm in 2016, and it's also trading at some discount to, global peers. So in that sense, CLSA says they're quite comfortable with the current valuations, while there will always be an uncertainty about whether, some more investors go ahead and sell the stock, which is unpredictable from here on. But they believe the stock is worth a look now, which is why they've gone ahead and upgraded it. Would you like to share your comments on Paytm and how you view the recent correction in the business model?
Well, Paytm is the one which started the top of the market at 18,600 last year. And no doubt it may be at the bottom of the market, but CLSA was one of the few who was calling for 14,000. I'm not commenting on them, but this is the way brokerages sell. So this is a large cap stock which has got a lot of floating stock, and most of it may be so, 450 to 650 may be a very well possible target. But these guys had buys at 1,800, 1,500, 1,200. So what is in there? It's just a trader's game. And most of the people, the investors, have lost out. I stand for the investors. I'm not going to take a punt at 200 rupees. I'd rather buy an ICICI Bank or an IDFC First, which gives me equal prowess into the financial space. But like you said, there's no point, there's no harm taking a call at 460, but please remember to exit at 650. Don't get sucked in by the euphoria, because these are all brokerages calls. A stock which from 2150 has fallen to 450 can surely rally to 700, but as the undertone change, that will take time. As a disclosure, our top play in this whole fintech basket is Zomato at 58. If you do get it there, or you can add some more, add that, because I think Zomato is the one play which we think we are confident can give you money in the next 1 year.
I see a lot of autos, right? I mean, in terms of the names that you mentioned, Sanjeev, Ashok Leyland, Tata Motors, Motherson, Bosch, right? That is a space which you think will continue to see acceleration, and especially a word on Tata Motors, because it's got so much global exposure as well.
Correct. So, Prashant, that's the reason this stock has lagged. But look at the way their CV market in India is expanding. Look at the way the EV market is expanding. And to give you a brief, the Slovakia unit in Europe is now fully geared up to meet the chip shortage and so on. And I think that Europe could be the dark horse as it comes back on stream after a lot of the uncertainty. And make no bones that I think autos definitely globally are in a short supply. So Europe will be the key for Tata Motor, making a comeback on the JLR. The China uncertainty is giving you the price performance. And that, I think, if China was reopening, then the stock would be at 600. So I think that a large part of the underperformance may be coming to rest. And since it's an inclusion in the index, it will see a lot of more pent-up buying in the sense of weightage. Ashok Leyland, I think, Prashant, you're seeing the type of expansion in airports. It is a conduit to rising air traffic. It's the rising airport, footfalls. And thirdly, it's the third largest bus maker in the world. And gaining more market share as reopening sees schools, institutions, corporates all go for that. Plus, you have the underlying theme of, scrappage policy coming. It's the best play to play with Indigo, GMR, and, Ashok Leyland. If you want to play the aerospace in India, which I think is just on the takeoff path.
Okay, all right. Sanjeev, thanks so much for stopping by and giving us a whole host of stocks, and look forward to chatting up with you and meeting you rather soon. Well, on that note, though,
thank you, Nigel. Bye.
We'll slip into a short break. On the other side, we have our technical experts who are waiting for us. Sudarshan Sukhani and Mitesh Thakkar will be joining us. Welcome back. Hope you're having a good morning. For starters, though, the SGX will be suggesting, because the overnight handover wasn't that great, maybe we'll pull back by around 50 to around 55 points odd. But a good time to get in our technical experts. We have Sudarshan Sukhani as well as Mitesh Thakkar, who are back with us. Morning, gentlemen. Thanks so much for joining in. Well, Sudarshan, you go first. We're getting a dip yet again out here this morning. What's your take? Yesterday, we came off the high point of the day as well. Will you be looking to get in at some point of time, or will you wait by?
Yeah, good morning. See, yesterday the idea was to avoid trading because the markets needed a pause. We've got that pause. We had a dip in the morning, then a rally, then an afternoon dip, again a dip in the morning. So all kinds of consolidation process has been completed. I think the Nifty is now a buying opportunity. So the dip should be used to buy. Keep a tight 100-point stop loss and go long in the Nifty. And I would suggest that the Bank Nifty although it's been doing nothing for the last 3-4 days, is also probably good for more upside. So the Nifty and the Bank Nifty both should be bought today with 100 and 250 point stop loss respectively.
Okay. Fair enough. Mitesh, good morning. Sudarshan, good morning. Mitesh, what about you? How are you set up in terms of the Nifty first?
Good morning, Prashant. See, on the Nifty, I think I would agree that the dip should be a buying opportunity. I think closer to about 18,450, 460. So not the immediate dip, but I think if we get another 30, 40 points lower, that would be a good level to enter and keep a stop below 18,400 and 18,600, 620. Now it's become established hourly pivot. So that becomes your first target. But I think eventually 18,750 could happen as well. So for the time being, yes, trade with a long bias. In fact, on stocks, I'd also be more of long calls. The Bank Nifty yesterday did not make a fresh high. That was pretty okay because it's been doing that for the last many days. But let's say a breakout above 43, 200, 250 zones could again propel strong momentum on the Bank Nifty. Otherwise, the Bank Nifty could be a mild drag and is already giving signs of getting into consolidation.
Good morning, gentlemen. So, Mitesh, you're gunning for the Nifty to head higher to 18,750. What would be the stocks that you would recommend with a bullish bias?
I have, in fact, good morning, Nima. I have 3 buys and a sell. On the buying side is IGL around 440, 441, buy with a stop at 434 for targets of 455. Delta Corp is a buy with a stop at 227 for targets of 243. And City Union Bank, that's a buy with a stop at 186.5 for targets of 195. And on the sell side is Airtel. Keep a stop at 847. Look for declines or pull back to about 815.
Okay, we got all those picks up for our viewers on the screen. Then Mitesh noted that. Sudarshan, what about you? Stock-specific action, what are you looking at?
Well, Chambal Fertilizers is a buy. I'm trying to look at stocks that are buy on dips. That has a deep correction, Chambal, and now some relative strength is showing up and momentum is also increasing. So that's a buying opportunity with a stop under 297. Voltas is a buy. Voltas was almost in a mini bear market. That may be ending for it. So let's look at an opportunity to go long. These are not necessarily intraday, but these are positional or even short-term investment ideas. So Voltas is a buy with a stop under 814. And Dixon is the only intraday short with a stop above 42.65. Finally, IDFC First Bank is a buy with a stop under 56. Most banks are doing well, and this one should join that party.
Buy Voltas and IDFC first and intraday short on Dixon Technology. Sudarshan, thank you very much for that. We'll keep coming back to you. For now, need to get into a break. We'll come back and get you the pre-opening rates. And also joining us will be Rajneesh Chopra of VA Tech Bazaar to talk about the 2,000 crore loan approval that they've got from Asian Development Bank.